to show you an example in relation to calculation of non-controlling interests. Here's an example. This parent that bought a subsidiary 60% of equity for 10 million. That was on 1st of July 2007. And the parent entity values non-controlling interests in the subsidiary at fair value. Now that is important for us to determine how the goodwill is measured and how much should be given to non-controlling interests, or whether we should not give anything to non-controlling interests. The fact that the next point is, at the date of acquisition, we are given the shareholders' equity. But that shareholders' equity in the subsidiary is as it appears on the balance sheet of the subsidiary. That does not mean that shareholders' equity is at market value. The third point says that the fair value of machinery is higher than the carrying value by 5 million. Now that tells us that machinery should be revalued by the economic entity because the subsidiary has not done it. And as a result, there will be a revaluation surplus that will be generated in the economic entity, but that should be assigned to the subsidiary because it is arising because the subsidiary has not revalued an asset to its fair value. The fourth point is, during the current year, subsidiary sold inventory costing 5 million to parent at a gain, but half of the inventory is still on hand. Then the fifth point is, during the year, subsidiary paid 2 million interim dividend and declared 4 million final dividend from post-acquisition profits. And the next point says, at the beginning of the year, current year, the subsidiary had a profit. This is the opening profit of 4 million. And profit after tax for the current year in the subsidiary is 1 million. Then it requires us to compute the elimination of investment, fair value adjustment, income tax impact from the fair value adjustment, depreciation adjustment in the current period, and so forth. Goes on and on and on. Let's look at part A. As we can recall the steps, the first thing that we have to do in consolidation is the fair value adjustment. The second thing is the elimination of investment entry. So before doing this part A, elimination of investment entry in subsidiary, you got to do part B, that is fair value adjustment. When you adjust the fair value, first is that you must reverse accumulated depreciation, debit that, and credit into machinery account to prepare for evaluation. And then you revalue machinery. And the adjustment required is 5. Once the revaluation is done, there will be tax implication, and part C is about the tax consolidation entry. So debit revaluation surplus 30% into 5, 1.5, and credit deferred tax liability. In calculating non-controlling interest, there's an additional thing that you got to do. What I'm doing, I have shown as the last column. I will write down as I go, as I complete consolidation journal entries, I will write down step with this step 1, step 2, and so forth. Now we are looking at finding out how much equity we should assign to the non-controlling interest. Therefore, in this analysis, we disregard assets and liabilities. Now see that I have written here for evaluation surplus step 1. The reason is for the part A entry, that is the elimination of investment, and that is the step 1, I got to bring the revaluation surplus here. So that is 3.5 is the revaluation surplus, but when I apply 3.5 into 60%, that is 2.7. So in part A is the elimination of investment in subsidiary entry. Generally, we do this after doing the fair value adjustment, but in this question, it is asking first. So don't get carried away. You got to do part B first to eliminate. Revaluation surplus is part of the shareholders' equity of the subsidiary to bring it to the market value. So now in this entry, reversing investment in subsidiary against shareholders' equity, including revaluation surplus. But to balance it, we need another debit. That means the parent has paid more than the fair value of identifiable net assets, and that is goodwill on acquisition. That's 4.3. The next one is the additional depreciation that is required because the machinery was revalued. And the additional depreciation that's required is for the previous year, that is 10% at the rate of 10%, 5 into 1 year, and then for the current year, and that's 0.5 and 0.5. Notice that for the opening retained profits, I've written there step 2, I made a note, and for depreciation expense, I made a note step 3. The reason for that is for the non-controlling interest calculation, we need to find out whether an item falls into step 1, step 2, and step 3. Anything that says opening retained profits is step 2. Anything that says expense revenue, that is step 3. And then step 1 is the elimination of investment entry, including revaluation reserve. And once we have done the additional depreciation for the revalued asset, there's a tax impact on that. So we write the tax impact of that. That is for the depreciation expense, there's a income tax expense reduction, and for the depreciation expense included in opening retained profits, there's a income tax reduction in opening retained profits, and then there's the other side is deferred tax liability. Again, I have written here step 2 for opening retained profits, and step 3 for income tax expense. Then the next consolidation entry is for the inventory. Now there are 3 steps for that. That is, first one is sales and cost of goods sold. The buy and sell transaction, sale and cost of goods sold are written there, step 3 for both of them, because they are revenue and expense items. Then second entry there is to eliminate unrealized profit and overvaluation component, and the inventory held is 50%, another 50% has been sold out and has gone outside the economic entity, and the economic entity has earned profits. So for the 50%, we debit cost of goods sold and credit inventory. Now notice that for the cost of goods sold, I've written there on the side step 3. To remind me, it belongs to step 3. Inventory is asset, we do nothing. And the tax impact is the third entry in that. With the cost of goods sold increasing, income tax expense decrease at the rate of 30%, and the deferred tax asset is 0.9, because the carrying value decreases compared to the tax base, and 30% of that is the deferred tax asset. And the next is for the dividends, and here the ownership matters, and the dividend what we eliminate of the reverse here are the dividend received and will be received by the parent entity. The first one is for the dividend revenue received and the interim dividend. So we debit revenue and credit interim dividends. The next is for the final dividends declared. So we debit dividend revenue and credit final dividends for the parents earning dividend revenue. And because these are dividends declared, not paid yet, there's payable and receivable, and we eliminate that by debiting dividend payable and crediting dividend receivable. Again, I have written there dividend revenue and interim dividend and final dividend revenue, step 3. Now that we have identified steps from the shareholders' equity and the earnings thereafter that the subsidiary has made, we have to assign a non-controlling interest. Now the shareholders' equity at the date of acquisition includes revaluation reserve plus the payment that was made for goodwill. So we allocate 40% of share capital, retained profits and revaluation reserve, and there was 4.3 of, we gross it up to make it 100%, and then we apply 40% to assign the share of goodwill to the non-controlling interest. We assign when the non-controlling interest is measured at fair value. It says that the non-controlling interest in the subsidiary is measured at fair value. We took the goodwill and then we crossed it up to make it 100%, and then we applied 40% to get the share of goodwill for the non-controlling interest. So that's the total shareholders equity, because this is the market value, that market value of shareholders equity. That includes revaluation reserve, and also remember that the parent paid more than that, assuming that there's an unidentifiable asset which is not represented in the shareholders equity at the time it was purchased. So that's why we include it here, that portion to be assigned to non-controlling interest. Step 2 is from the date of acquisition to the beginning of the period. Anything that says opening retained profits, we bring it here. If it is a credit, we add it, and if it is a debit, we deduct it. So we take the increase in profits from acquisition date to beginning of the year, which tell us that it's beginning of the year opening profit is 4 million, and then we find from the shareholders equity here in point 2 it says that is 2 million. From the 2 million, 40% should be given to non-controlling interest. Now, in addition to that, there were intragroup transactions. From that, we also found out there's a debit item and a credit item. So we go back here and we find that there's opening retained profit mentioned here as a debit item 0.5, and opening retained profits mentioned here as a credit item 0.15. So it's a debit and a credit, and we assign 40% of each of those items, and then we add it up. Non-controlling interest in step 2 is 0.66. Then we go to step 3. Our profit after tax is given to us. It is 1 million. It says 1 million, the last point.